Welcome back, everyone, to the Audacious Money Witch channel, where we talk about investing and trading and a lot of fun things. Disney stock is about to change for good. Today, I want to talk about my Disney stock. Disney stock is my dividend play. Although it has a lot of depth, the company has a strong brand and wide moat. And I know that Warren Buffett has lost a lot of money buying Paramount.
No, it was 100% my decision. We sold it all and we lost quite a bit of money, and that happens in this business too. Actually owning Paramount made me think even further, think deeper, harder even about the whole question of what people do with their leisure time and what the governing principles are of running an entertainment business of any sort, whether it's sports or movies or whatever it might be. And I think I'm smarter now than I was a couple years ago, but I also think I'm poorer because I acquired the knowledge in the manner I did. But I just want to be very clear that A, we lost money on Paramount, and B, I did it all by myself, folks.
And I think the Walt Disney Company is a much safer stock than Paramount. Warren Buffett said that Bob Iger is a home run maker. So instead of buying Paramount, he should have bought Disney instead. Because right now, Disney is still trading at the same price as 2015. I also want to talk about the subscription business model. You own nothing, but rent everything. The Walt Disney Company surpassed analyst estimates with its fiscal second quarter earnings and provided good news from its streaming arena. Although it is still behind Netflix on the streaming front, when excluding ESPN, Disney Plus, and Hulu reported a combined profit for the very first time. However, shares tanked 10% upon the report as overall revenue failed to impress the fourth straight quarter. And Disney guided for a softer third quarter for the experiences segment. For the March quarter, Disney posted revenue grew 1% year over year to $22.08 billion, coming short of analyst estimate of $22.11 billion. Theme parks continue to do well, with the U.S. parks and experiences revenue increasing 7% to $5.96 billion, with increased attendance and higher prices at the Hong Kong Disneyland Resort. International sales jumped as much as 29% to $1.52 billion, but California Resort posted lower profits due to higher labor expenses. Restructuring and impairment charges pushed Disney to a loss of $20 million or 1 cent per share, down from last year's comparable quarter profit of $1.27 billion or 69 cents per share, but adjusted profit of $1.21 per share topped analysts' expectations of 1.1 cents. Disney is making progress in catching up to Netflix when it comes to streaming profitability. Streaming business brought in revenue of $6.19 billion. The direct-to-consumer business that includes Disney Plus and Hulu went from a loss of $587 million during last year's comparable quarter to an operating income of $47 million. Streaming revenue rose 13% to $5.64 billion. Disney Plus core subscribers also grew by 6 million, with the Netflix rival now having 117.6 million global customers. However, when adding ESPN Plus into the equation, the streaming businesses lost $18 million, but it improved significantly from last year's comparable quarter when the loss amounted to $659 million. On a less bright note, content sales, licensing, and other revenue that includes box office tanked 40% to $1.39 billion. Disney warned that current quarter's results for the parks and experiences business will be weighed down by higher expenses and attendance normalization following a post-pandemic demand surge. Also for the current quarter, Disney guided for softness in overall streaming business due to its platform in India. Disney Plus, Hotstar. Still, Disney expects its combined streaming segment to reach profitability in the fourth quarter and become significant growth driver with further improvements in profitability in fiscal 2025. The streaming milestone came none too soon as the traditional TV networks business continues to fade into history. Iger's turnaround and growth initiatives that were set in motion last year to revive the world's biggest entertainment company are bringing positive results, with entertainment streaming finally reaching quarterly profitability. Disney is on track to achieve profitability in its combined streaming businesses in the fourth quarter as it continues its efforts to catch up to Netflix. Walt Disney and Warner Bros. Discovery will offer a bundle of the Disney Plus, Hulu, and Max streaming services in the United States starting this summer. This is Disney's challenge to Netflix. Customers will be able to sign up on any of the 3 individual websites and choose from an ad-free or an ad-supported plan. Both Disney and Warner Bros. Are trying to build their streaming businesses as customers ditch traditional cable packages, in part because many of them rejected having to pay for a large bundle with dozens of channels. But as the number of streaming apps exploded, consumers have complained about having to sign up for multiple subscriptions. The Disney-Warner bundle will simplify payment with one bill and possibly offer a discount from the cost of subscribing to each app separately. Disney Plus offers the company's animated and live-action movies plus film and TV shows from Marvel, Star Wars, and Pixar. Hulu features series from FX, ABC, and other networks, as well as movies. Warner Bros. Max is home to premium channel HBO, as well as HGTV, the Food Network, the Discovery Channel, and other cable networks. Disney Plus and Hulu are already available through a single app, which means customers of the new bundle will be able to watch all of the programming through 2 apps. Looking at Disney's film studios, they have a number of highly anticipated theatrical releases arriving over the next few months, including Kingdom of the Planet of the Apes, which opens this Friday, as well as Pixar's Inside Out 2, Marvel's Deadpool and Wolverine, and 20th Century Studios' Alien, Romulus, which are all slated for this summer. Later this year, I am looking forward to Moana 2 and Mufasa, The Lion King. And in 2025, Disney remains just as robust with the Captain America, Brave New World, Fantastic Four, Elio, Zootopia 2, and Avatar 3. Prepare to see Jessica Alba in Fantastic Four. Disney is working hard with the studio to reduce output and focus more on quality. That's particularly true with Marvel. In terms of television shows, some of what is coming up as a vestige of basically a desire in the past to increase volume. They're slowly going to decrease volume and go to probably about 2 TV series a year instead of what had become 4, and reduce the film output from maybe 4 a year to 2, and they got a couple of good films in 25, and then Disney are producing more Avengers, which I am extremely excited about. So overall, I feel great about my Disney stock. I am glad they are committed to spending more and more time on entertaining us. Regarding the investment in the parks, the financials shows it's a 25 plus margin business and has been for an extended period of time. It has terrifically high guest satisfaction scores, which create layers of advantage, which suggests we should be able to sustain high margins and high returns on investment. With a business with that profile, you invest in it. We know there are lots of opportunities to continue to grow attendance, both domestically and internationally. And the cruise business, frankly, is one that has an enormous number of opportunities for us over time. And that is why Disney are leaning more heavily into that business. So obviously, they're not investing capital to achieve poor returns. They expect to get excellent returns out of the business. In particular, in cruises, given the margin profile of the business and the fact that it's got the highest guest satisfaction scores in the company. In terms of the stock, I intend to buy more when it's under $100, when its free cash flow yield is above 5%. Right now, it's at 4%.